On September 18, 2014, the Emerging Issues Task Force reached a consensus for exposure with respect to how master limited partnerships would present earnings per unit for drop-down transactions occurring post-formation. Welcome to the KPMG Podcast on EITF Issue 14A, Effects on Historical Earnings per Unit of Master Limited Partnership Drop-Down Transactions. Today is October 7th, and during this podcast, we will discuss why this issue was taken up by the task force. We will also provide an overview of the decisions reached at the September 18th meeting with respect to EITF 14A. My name is Robin Dunn, and I am joined here today by Dan Amat, and we are both senior managers in KPMG's Department of Professional Practice. Dan, can you give us some background on this issue and why it was brought to the attention of the task force?
Yes, thank you, Robin. Quick background on MLPs. These are structures where a sponsor will usually convey assets or a business to form the MLP, and the MLP will in turn issue common units to the public to pay the sponsor for those assets or that business. The sponsor often becomes the general partner, and as general partner will hold a small percentage of the partnership units, but will manage operations and therefore have control over the MLP. What you end up having is multiple classes of securities for MLPs. You have common units held by limited partners, that's the general public. You have a general partner interest, and then often you'll have what's called incentive distribution rights, or IDRs. So the partnership agreement will dictate how distributions are to be allocated to each class of security. And because you have different classes of securities that are participating in earnings differently, ASC subtopic 260 requires that MLPs use the two-class method to calculate their earnings per unit. So what often happens in practice is that after the formation of an MLP, GPs will convey an additional business to the MLP in exchange for cash or added ownership interest, and this is referred to as a drop-down transaction. In most cases with the drop-down, the GP retains control of the MLP before and after the drop-down. So what this means is the transaction is accounted for as a reorganization of entities under common control.
So Dan, when we say reorganization of entities under common control, that means not applying normal business combination fair value accounting. Is that right?
That's right. The dropped down business comes over at its historical cost, and the results of operations for those two entities, the MLP and the drop down entity, are combined as if they had always been combined from the date that those two entities were under common control. So you end up having a retrospective adjustment of the income statement. And so that brings us to the issue. Currently, specific to the calculation of earnings per unit, there is no guidance addressing how to present EPU for periods prior to the date of the drop-down transaction, and that's created some diversity in practice. There's two main approaches that have been taken, and those two approaches are actually the two alternatives that the EITF considered at their September meeting. These are the two ways that people were doing it in practice. So alternative one says that we're going to take those pre-drop-down periods, and we're going to allocate net earnings of the transferred business to the GP, LPs, and IDR holders as if those security holders had always had rights to those earnings. Alternative 2 says that the net earnings of the drop-down business belong to the general partner, and so when we retrospectively adjust the income statement of the MLP, all the earnings of the drop-down business are going to stay with the general partner, and the effect there is that the earnings allocated to the limited partners do not change.
All right, Dan. So I actually think an example would help to illustrate and contrast these two alternatives.
Okay, great. I happen to have an example handy right here. So we've got a very simplified table here, but basically what this is showing is it's on top you've got an MLP, 3 years of historical earnings, and then at the bottom you have results for a company that's going to be dropped down. We say here that the drop-down transaction happens on January 1st of 2014, So we're dealing strictly in this issue with the years prior to the drop-down date. So we've laid out here total earnings, and then for the MLP, what historical net earnings had been that are allocated to the GP. We show the combined earnings under each alternative. So the key thing to highlight here is that under Alternative 1, the net earnings, the top row, that's just an A plus B of the two entities. But when you get to the GP interest, they've only taken a small portion of the drop-down business earnings. Whereas if you look at the bottom half of the slide, Alternative 2, the GP has gotten 100% of earnings prior to the date of the drop-down, such that the net earnings available to the LPs does not change for those prior years.
What were the proponents' views on each of these alternatives to support their respective views?
For Alternative 1, the main point in favor of that is that it follows the guidance for reorganization of entities under common control. There is one key difference, though. For most organizations that apply this, they're corporations who only have really one type of security that participates in earnings. So you don't have the complexity of having multiple securities with different participation rights. The main point in favor of Alternative 2 is the guidance in the two-class method for accounting for EPS when you have different levels of participation for different securities. And that guidance really says that you should follow the economic or contractual participation rights. In the case of an MLP, the limited partners and the IDR holders don't have any economic or contractual rights to the earnings of that drop-down business prior to the date of the drop-down transaction.
So what was the EITF's decision? And word on the street is that this is one of the quickest decisions they've made at a meeting in history.
That is true. It was quick deliberation, and Alternative 2 was pretty quickly chosen as the route to go. A couple other things. They decided for a brief additional disclosure to describe the impact of the drop-down on EPU in the prior and current year. And then the other thing they decided was that retrospective transition would be most appropriate. In terms of timing and next steps, the FASB will need to approve this EITF consensus, and then an exposure draft will be issued with a request for comments.
All right, thanks, Dan. For more information on EITF Issue 14A, please refer to our Defining Issues publications, which summarize the issues discussed and decisions reached at the September 18th EITF meeting. This Defining Issues is available for download at KPMG's Financial Reporting Network website. Thanks to our audience for tuning in, and take care.